Just like any tool in life that you use for a process, it all comes down to how you use it. And so the only person that can break the tool is the person using it. And so if you don't use the tool correctly, then yes, you could be in a position where you could lose money on it.
You shouldn't lose money, and it's really it's the lowest risk thing I've found to do with my money. Can you lose money with the infinite banking concept?
It's a great question. So
the truth is, money has to be stored somewhere, right? Our money has to be stored somewhere. And so here's the question that I kind of want to kick off tonight is, where do you store your money? And type it in the chat box. Where are those places that you store the money that you have? So we got some answers coming in here. So bank. Oh, nice. Under the mattress. That's a good one. It's a good place to keep it. Some people saying gold and silver, bank, investments, credit union, TFSA, Bitcoin. Those are all really good answers, and more coming in. Land, real estate. Cool. Because the truth is, for a lot of us, right, we store our money typically in a bank with those bankers, right, at the big bank. And frequently, maybe you've heard that phrase, and it's gone. So here's the second question that I want to ask. Why do we store our money there? So wherever you store your money, why is it that you store it there? Type those answers in the chat box there. All right, so safety, privacy from Gloria there. Lack of knowledge, yeah, totally. We just put it where we're kind of told to put it, hey? Thought it'd be safer, what we were told to do. Some for accessibility, others you don't, just get the money and it goes right there. Those are all really, really good answers. So a few weeks ago, my wife and I, we actually won tickets to the Edmonton Symphony Orchestra. And as we were driving downtown, I saw all these really, really, really tall buildings with the names of banks on the side. And so seeing those bank buildings kind of got me thinking. And watching that video at the beginning really gets me thinking. And it just gets me thinking about, it must be really nice to be on that side of the desk as a banker. There's got to be perks to being that banker and to owning those big buildings downtown. And so another question here, because I really like having that interaction. So write in the chat box, what might be some of those benefits of that those banks or those bankers enjoy? So what would be a benefit that you can think of that a bank or a banker might enjoy? Better investments, yeah, control, right? If you own a big giant bank, you're probably in control, right? They reinvest money and make 20x return. Totally. They get to use the money that gets put there, charge fees, charge commissions. Yeah, absolutely. There's so many different reasons. So, John, can you go to the next slide there? Yeah, so there's so many different reasons of benefits of being a banker, right? They share in profits, they earn fees, they earn interest, control. They have the access to capital. For 99% of people in Canada and the United States, do we really get to enjoy those benefits that those big banks or those big bankers might enjoy? No, no, no. Yeah, type an N in the chat, or if you think it's no. Yeah, lots of no's coming in there. Yeah, that's the truth, is that for most of people in Canada and the US, right? Those banks and those bankers get benefits that we don't get to experience. And the reason for that is, the bankers, they have the gold, so they make the rules. And now banks, obviously, they play a super important part in our world, and they do that job really, really, really well. But you know what? Are they really looking out for what's best for you and I? Right? Are those big banks and those big bankers, are they looking out for what's best for you and I. Type N in the chat box if you think they're not looking out for what's best for you and I. No, no, lots of no's coming in. Okay, now I get to turn it over to my friend and teammate John, and he's going to keep talking about the negative sides of dealing with bankers.
Thank you so much, Paul. Okay, so we've just heard Paul talk about the benefits. Now we will look at the negative side of dealing with commercial banks out there. Who here thinks that the banks are their friends? And please put down if you think that the banks are your friends on the chat box for me. Okay, so I'm getting a lot of no and not. Absolutely. And sometimes they will be your friends. Is it when you really need them, they will give you favor? Or is it when you don't really need them that they will give you favors? When you need access to capital to jump on on one opportunity that's really unbelievable. Please put it down on the chat whether it's when you need them or when you don't need them that they will give you access to capital. Very good. So isn't it interesting that, and also mind-boggling, that when you don't need them, they will throw money at you. And when you really need them, and that can make a big difference in your life, that's when they turn their back to you. Now, let's look at some of the negative side of dealing with the banks. When you need capital, let's say you need a mortgage, or you need to take on a venture, you find an opportunity. How easy do they make it for you to have access to capital? Please put down there if it's easy to get access to capital when you need it from the commercial banks. Almost impossible, I'm reading. Hard, very difficult, not at all, not easy. That's so true. And they will have you jump through so many hoops. They will have you give a credit report, find somebody else to support your name, and it's really, really difficult to have access to capital in dealing with the commercial banks. And here are some of the answers here. So the reason why it is so hard to have capital from the commercial banks, it's because they are in control of that precious resource, the money, or we can call it, in the great book, Nelson Nash put it brilliantly saying, whoever gets the gold makes the rules. So these guys, they have access to the capital, they have a bunch of it, so they control it, they keep it, and they make it really hard for you to have access to it when you need it. And another way you can see it is who is doing all the work? Who has to wake up and hustle and bustle every day to bring in the money? You, me, my neighbor. But who is putting it to work and reaping all the rewards? And do they share in the rewards with you? And the answer is obviously no. And like I see, a lot of people are putting down there, not at all. Thank you for participating in the chat down there. I really appreciate it. We like this interaction. Now, not having control to capital is part of the problem. Now, how would you feel if you could control the banking function in your life? Tell me, you wake up tomorrow, you have all the money in the world, and you can you can have access to capital, and also you can put it to work, taking a lot of advantages regarding opportunities. How would that make you feel?
Getting some answers here, John. It's empowered, peaceful, perfect. Woohoo. Good
Awesome.
one.
Awesome.
Amazing, in control, great. Would love it. So many good answers coming in here.
Very good. And tonight we will show you that you don't need to be a millionaire. There is a very specific process that you can go through with our help, with our coaching, that could give you access to your own capital on your term. Now I'm going to pass it over to my good friend, Dan Allen.
All right. Thanks, John and Paul. So I'm just going to do a share and we'll get started. Can you confirm that you see my slide now?
Yep, we can see it in.
All right, excellent. So here's a little fun exercise that I wanted to walk everybody through, and it's just going to make you think. And there's nothing too tricky about it, but here's the first question I've got for you. Who likes low interest rates? So just put in the chat if you happen to like low interest rates. If you don't, that's okay. Just wanted to get a sense as to who likes them. What kind of answers are we getting there, Paul?
A lot of yep, yes,
All right.
oh yeah, I do, I do.
Great.
Lots of yeses there.
Yep. So I don't mind low interest rates at all, but I really wanted you to think about what do low interest rates encourage people to do? Just put your thought down. What does low interest rates encourage people to do?
Getting purchase, spend, buy, borrow, spend money, borrow, lots of spending.
So yeah, so not to save, right? So that's what it
Someone wrote
doesn't.
invest.
Okay, invest, all those good things. So what low interest rates don't encourage us to do is to save. And when you don't save, you borrow. And what happens when you borrow? Well, it's pretty straightforward. You become a slave to the bank. And, that's what happens. You ever, you realize once you get a debt, you're on the hook to pay those payments. So you become a slave to that debt. Now, I wanted to ask you this question. With low interest rates, who gets all your money? Ever think about that? When interest rates are really low, who gets all your money? Let's put an answer in the chat.
Getting some, the bank, others, the bank, lenders,
All
lots
right.
of banks.
So anybody that lends you money, that's who's going to get it. Now it's kind of another great question. With high interest rates, who gets all your money? I think we've all figured this out, right? Whoever lent you the money, and if it's the bank, they get all your money. And just like John had said earlier, in both cases, you're doing all the work to earn money and someone else gets it. Money is being transferred away from you and it has nothing to do with rates. That's right. It has nothing to do with rates. Interest rates at which you borrow is not the problem. That's, a lot of people think, they spend a lot of time focused on what interest rate I can get, but I can tell you the interest rate is not the problem. The problem is you're not the one controlling the banking function. That's right. You're not the one controlling the banking function as it relates to your needs. So now you know what the problem is. How would you go about solving it? Well, tonight we're going to talk about the infinite banking concept and how it solves the problem for what we just talked about. So what is the infinite banking concept, you say? Well, on page 14 of his book, and if you don't have a copy of this book called Becoming Your Own Banker by Nelson Nash, you have an opportunity. Everything you need to know is in the book. And what Nelson wrote It's an exercise in imagination, reason, logic, and prophecy. So we're going to go through those 4 principles for you. So let's start with imagination. And why would imagination matter? I thought I'd use this quote from Albert Einstein. Most of us know who Albert is. And he said this statement, imagination is more important than knowledge. That's right, more important than knowledge. So why would he say that? Any thoughts? Why would Albert Einstein say imagination is more important than knowledge? Well, here's the answer, right from Albert. Knowledge is limited. Have you ever seen the circle of knowledge? So here's just a picture that I'm going to use to help explain that. So this inside circle is what you know. And then just outside of it, the next circle is what you know you don't know. And beyond that is what you don't know you don't know. And so as you can imagine, if you expanded your knowledge and you move from this ring to this ring, you'd still have this outer ring. And you think about how much more knowledge that is that you know about, but you don't know. And then beyond it, there's going to be more knowledge that you just don't know. So that's the thing, that's the problem with knowledge. There's a limit to it. So no one person can know even close to all there is to know. So that is why imagination matters. So what is imagination? Well, imagination enables us to transcend the limits of our immediate knowledge. So it allows us to think beyond what we know. It enables us to explore new realms of possibility. So with that, let's put our imagination to work. And we already talked about this one, but I want you to really take the time and think about it. What would it be like if just a few years from now, you had access to all the money you needed for anything that mattered for you, for your family, or for your business? What would that be like? How would it transform your life? So how would you do that? Well, we're going to talk about that tonight. We're going to talk about how you could go on using the infinite banking concept to create a warehouse of capital. Access to capital that you could use for all of your financial needs. And the key thing with that access to capital, it needs to be liquid. It needs to be something that you control. And over time, it won't happen immediately. It will allow you to control 100% of your needs for finance. Now, just imagine the position that would put you in again. How would that make you feel? For you, for your family, and for your business? But I think we all know, what is it we've been taught to do out there? And this is really what the problem's all about. Mankind has turned the warehousing of wealth function over to bankers. And when you do that, well, what happens? Well, simple. You lose control. You're giving control to someone else. So I wanted to leave you with a few more thoughts from Albert. One is, the world as we have created it is a process of our thinking. It cannot be changed without changing our thinking. So again, when you think about imagination, imagination is more important than knowledge. So that is the first principle we're going to speak about tonight. Now I'm going to turn it over to Turan, and he's going to talk about reason and logic. Turan, take it away.
All right. Thank you very much, Dan. So, share my screen here, and you should all see my screen.
Yeah, we
Don't
got
just let me know. Awesome.
Yes.
So we're going to dive into reason and logic. All right. So what I did is I went to our good friend Google, and I actually found the definitions on what those two terms are about. So starting with reason. Reason is defined as the power of the mind to think, understand, and form judgments by a process of logic. Okay. And logic is reasoning conducted or assessed according to strict principles of validity. Now, what I find interesting in those two definitions is logic includes reasoning in its definition, and reasoning includes logic. So they are both interconnected in a way. They have a symbiotic relationship, if you will. Okay, so we're going to dive through some thinking exercises to help us understand how we apply reason and logic to the infinite banking concept, right? So question, why do you want to grow your money? Throw it in the chat. What are some reasons as to why you want to do it? And if someone can read out the answers as they
Yep.
come through.
We got some financial freedom here, Taran. We got to live, retirement, family, inheritance for my kids, retire early. More dollars is better than less. Control.
Awesome. Awesome. All great answers. And it's very similar to what I will be going through right now. So I heard financial security, right? Ensuring stability, covering unexpected expenses without any stressful situations. Retirement planning, right? I heard that as well. Building a sufficient nest egg that supports a comfortable lifestyle. Wealth accumulation, increasing overall wealth for long-term goals. Like some of you may want to purchase a home, start a business, travel the world. Beating inflation, protecting your purchasing power. We've all seen what inflation has been doing the last couple of years. Achieving financial freedom. I saw that as a common answer as well. Reducing which is essentially reducing the dependency on traditional jobs or lenders and having more control over your life decisions in general. Legacy building, leaving wealth for future generations, your kids, your grandkids, ensuring that their financial well-being is taken care of. In order to achieve all these objectives, what you need to do with your money is to grow it. You can't have it sitting still. You have to let the money grow in order to have enough capital to meet these objectives. Here's a question for you all. If person A and person B both put $100 away every month, who will end up with more money after 30 years? Throw the answer in the chat.
Depends on how they use it. Depends who has better imagination and information.
I love the answers.
The one that saves the most. The banks.
Okay.
There's a good answer there. The banks.
Okay. I love those answers. So let's say we keep everything equal in the situation that they all put it into one place, okay? And so they each consistently do $100 per month, nonstop for 30 years. Chances are they're both going to have the same amount of money. Now, will that money be less in the future in terms of it being depreciating in value? The answer is yes, right? And all the other answers and variables that you all shared does come into play. But if you just keep all else equal, they will essentially have the same amount of money at the end of 30 years. Okay. So a follow-up question to that, if person A and person B, once again, put $100 away every month, but person A withdrew that money that they accumulated after 10 years, who will now end up with more money after 30 years? Again, all else equal.
Got some B's coming in. Someone said probably A, B, B, B. Lots of B's coming in, Tran.
Yeah, lots of B's is right, because in this scenario, person A withdrew the money after 10 years, so that money is no longer there. Okay, whereas person B has left the money in that warehouse where he put it. Okay, and so that kept accumulating over time, and so he is definitely going to have, or they are definitely going to have more money than person A. And that brings us to this point. In order to allow your money to grow, you have to allow it to compound. And in order for the compounding to happen, you have to let it happen. You cannot interrupt it. In my example, in my question, person A interrupted the compounding by withdrawing the money, whereas person B lets it happen by leaving the money there. What happens if the money's not growing? Well, it's pretty obvious, right? It stops compounding. Okay. And that's the problem with what you're dealing today with the vehicles and the warehouses you're currently using to save and invest your money. Okay. The problem with the way you're growing your money today is that you keep interrupting the compounding. Yeah, and there's a reason why you do that. Why do we need to do that? Why do we have to? Why are we forced to interrupt the compounding with the savings accounts that you use, with the investment accounts that you use?
Have to live to use it, pay for living expenses. Someone put emergencies on here. Yeah, arising needs. Lots of different reasons here.
Yeah, exactly. So if you summarize all of that and simply said, it's because you need access to the money for all the reasons that you all mentioned. Okay, whether it's spending on expenses, whether it's investing, whether it's emergency expenses, whatever your need for money is, you need access to it. And when you need access to it, you go into your savings account, you go into your investments to access the money. And when you do that, those accounts deplete because you're interrupting the compounding and you're removing the money from that asset. And that is another part of the problem that we discussed earlier. If the money stops compounding, will it take less or more time for you to get to your objectives?
More time.
More time.
Lots of mores.
Awesome. And so what we're doing here with these questions and these exercises is we're applying reason and logic to our thinking. And so the problem we need to solve is to allow the compounding to continue to happen. We need to allow it to happen forever in order for us to have more capital to access to meet the objectives that we want to meet. And as I said earlier, in order for our money to grow, we must not interrupt that compounding. Anything illogical about that, just let me know. So here's another exercise to go through, okay? Another question. If person A and person B both put $100 away every month, who will end up with more money at age 75 if person A is 10 years younger than person B?
Lots of A's there.
Okay, and why is that? Why would person A be better off?
They have more time.
Bingo. You have more
longer
time.
time to compound.
Longer time to compound. In order for your money to compound significantly, you must give it time to allow that to happen. And so, how do you maximize the compounding? You simply start the process of compounding as early as you can. Okay? And once again, if there's anything illogical about that, just let me know. So the key ingredients to growing your money are uninterrupted compounding and time. Okay? And the infinite banking concept contains both these ingredients, which is what makes it so powerful. Okay? So I want you to go back to your why. Think about your why. All the things that you shared with me when I first asked you that question. You said financial security, retirement planning, wealth accumulation, beat inflation, achieve financial freedom, legacy building. So in order to achieve those objectives, is there anything illogical about using a system that can compound your money day after day after day after day, uninterrupted. Just throw your Y's and N's in the chat.
No, 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 lots of ends.
Yeah, absolutely. Absolutely. When you have a system where your money is continuously growing, it looks like what my hand is looking right now. It continuously grows and you're going to continuously have access to it. We're going to dive into more of those details as we go along today. All over to you.
Awesome. So, John, can you just keep sharing your screen there?
Yeah, no problem. I'll go back in here.
Thanks. So now, so Dan kind of mentioned at the beginning those four things. There's IBC is an exercise in imagination, reason, logic, and prophecy. And so I'm going to just take a couple minutes here and I'm going to chat about prophecy. And really, when I think about those four things, I find that this one can be the most confusing. So my goal over the next couple minutes is just to simplify it just a little bit. So when I was in high school, and we've all been there, right? In your early 20s, in your teenager years, when you were out with friends and you needed a meal, where would you go? For me, it was always McDonald's, right? We would always stop. I would get a Big Mac. I loved those Big Macs. But the thing is I'm not 18 anymore, right? Can you imagine if every single day I went to McDonald's 3 meals a day and had a Big Mac meal? Do you know what would happen to my body and what happened to my mind? And so let's hear from you guys. Write it in the chat. What do you think if I did that? McDonald's Big Macs every single day for let's just say 60 days. What would happen to my body and to my mind? We got supersized Paul. That's a good one. Yeah, it's true. I would grow. Not good. Malnutrition. You would get sick. I'd get incredibly sick, right? Very sick, unhealthy. Yeah, I'd probably gain like 300 pounds, right? Because, McDonald's is not great for us. So if I created the habit, right, of constantly eating McDonald's in my life, I could really predict, and we could all predict what the outcome to my health, to your health would be. And so bringing that back to prophecy, do you know that the simple definition of prophecy is it's simply a prediction? Right? A prediction of what could happen or what could be in the future. And that's really the easiest way to describe prophecy. So if I had a habit of eating McDonald's every single day, I could predict or I could prophesy in the future what my body would look and feel like in 30 days, in 30 months, or in 30 years, because our habits predict our outcomes. Or another way to say that is our habits can prophesy our future. And so that principle really is true with what we eat, whether I eat a burgers or a salad and how much I exercise. That principle is true also with how we handle our money. And that principle is really true with the infinite banking concept. If we could have good habits around how we handle money, we can predict or we can prophesy what the future will look like in regards to our finances. If we understand infinite banking concept, if we set it up properly and live out the principles that Nelson Nash laid out in the book, Becoming Your Own Banker, we can predict or we can prophesy what our financial picture would look like in one, or what it could look like in 1, 5, 10, 25 years from now. And in a world of taxes, inflation, interest, here's a question that I want to leave you all off with is, would there be any downside to being able to predict what our financial future could look like? Is there really any downside in understanding what it could look like? And so with that, I'm going to turn it back over to Taran to dive a little bit deeper into the tool of infinite banking concept.
All right. Thank you very much, Paul. So IBC, as we've mentioned, few times now, is an exercise in imagination, reason, logic, and prophecy. And we just walk through those 4 principles with you so you have a better idea of what that all means. Okay. So now how would you put that into practice in your life? Well, with like anything in life, you need to use the right tool to implement the process. Okay. So the tool that we are going to go through is simply the tool to implement the process of infinite banking. The tool is not the process itself. Okay. So there's a distinction between the two. The process is the infinite banking concept, and the tool is what I'm going to show you in a couple minutes. Okay. So another analogy to hit it home is you see a hammer and a nail here. Putting the nail into the plank of wood is the process. The tool used to do that is the hammer. Okay. So the tool we use to implement the process of infinite banking is a participating, dividend paying whole life insurance policy. Okay. And I'm going to dive into how we can use this tool to implement the process of infinite banking and those 4 principles of imagination, reason, logic, and prophecy. Okay. So a dividend paying whole life insurance can help create peace of mind and unmatched financial security if it is used correctly. Okay. So again, you have to use the tool correctly. So here's how. There are some components that you need to be aware of when it comes to the tool. So the 3 main that you have to be aware of is premium, which is the deposit that you make towards the insurance company. Okay. And in exchange for that amount, you get covered for a certain amount of death benefit, which is the payout that occurs when you become an angel. Okay. And then the other term you need to be aware of is cash value. So cash value, by definition, is the present value of that future death benefit. Okay. So cash value is something that begins accumulating immediately. As soon as you start the life insurance policy contract, your cash value begins accumulating. And it is guaranteed to grow daily because there is a built-in contractual guarantee in these life insurance contracts. Okay. And the contractual guarantee is by age 100, that death benefit and the cash value have to match each other. Okay, so your death benefit starts here and your cash value starts here when you start the policy, if you're seeing my hands on the screen. And then every day, the cash value is rising to catch up to that death benefit amount by age 100. Okay, and that is a very important factor or principle to keep in mind. The cash value growth that occurs, the daily growth that occurs, it occurs on a tax-free basis and it cannot go down. Okay, it's contractually, the life insurance company is contractually obligated to grow that cash value every single day, regardless of what happens in the outside world. The cash value is something that you get access to while you're alive, and you can take advantage of it to use it for opportunities that you will start attracting once you start implementing this process of infinite banking. Okay. When you access the cash value, you're not penalized for accessing it early like you are in some of the other financial products that you use today. Okay, so that is an immediate plus. And it provides a growing death benefit, which is paid to your named beneficiaries tax-free. Okay. So there are 2 ways to access the capital when you set up the policy. Okay. The first way is by withdrawing the capital. And then the second way is by accessing it via a policy loan. Now, when you withdraw capital, that is the same as interrupting the compounding. And remember, we just talked about it when we talked about reason and logic. Okay. If you want your capital to grow, does it make logical sense to interrupt it? Give me a Y or N in the chat. No, no, you want, exactly, very good, right? You want to let that money continue to grow. Otherwise, there's no point implementing this process, right? So we don't want to ever withdraw our cash value. What we want to do is we want to borrow against it by utilizing a policy loan, okay? And when you utilize the policy loan, the cash value is not touched, okay? So it continues growing. The insurance company uses it as a collateral, but the cash value itself continues growing. It is not, the growth is not interrupted. And that's what we want. And as I said earlier, it doesn't matter what happens in the financial world outside of these policies. So stock market, real estate market, crypto market, those markets can go up or down, but your policies and the cash value in your policies can go only one way, and that's up. So here's an image to think about and something that I encourage you to sear to your brain, okay? So what you see here is a dotted green line that is continuously going up, and it's going up exponentially over time. We call that the hockey stick curve, okay? That represents your cash value, okay? The green dotted line. And the other green or light blue dots on screen is moments where you access your capital against that growing cash value, okay? And so this represents you taking out a policy loan, and then as you make repayments to that policy loan, which I'm going to get to in a second, you're replenishing the capital back into your system, and then you're able to access it again at a later stage. Now, when you access it again at a later stage, in my example here, are you getting to access more or less capital? What do we got in the chat here?
More.
More capital is correct, because you are not interrupting the growth of the cash value. And so if you are not interrupting the growth of the cash value, and in that example, when you access the money and you're putting it back, and then you get access to more money, how does that make you feel?
Saying powerful, secure, good, empowered, great freedom, uh, happy face, in charge, in control.
In control. I love that last one. In control is a great answer. Yeah, and there were all great answers there. And so contrast that with what is happening today with where you're storing your money. Okay. Think about the savings, the checkings accounts that you use, even your investments accounts. When you go to access the money, your money is depleting. And then you have to work harder to replenish the account so that you can bring it back up and allow the compounding to continue happening. Otherwise, you continue to interrupt the compounding because you keep needing access to that money. So we just flip it on its head. We still have access to money, but we never interrupt the compounding when we implement the infinite banking concept. So here's something you need to know about policy loans, okay? So I've alluded to some of this already, but it's great. Repetition is always great. So there's no impact to daily cash value growth. There's no reduction of death benefit while alive. There's no negative impact to dividends, and there's no exposure of the loan. So it does not show up on any credit report. These are private loans, okay? And at death, or when you become an angel, the outstanding, if there's any outstanding loan balance, it simply gets deducted from the overall debt benefit, and then the remaining debt benefit is paid out to your beneficiaries. on a tax-free basis. When you need to access a policy loan, it is a simple request that you do online. So when you set up your policies, you get an online portal through which you can go through a 5-step process that takes 1 minute the first time and then 30 seconds for every time after. Okay. And all you need to know is where you want to deposit that money and how much you want to take out as a loan. Okay. There's no qualifications needed. You don't have to show any credit reports. You don't have to show any proof of income. Think about all the times you go to the banks and you ask, and you are asked for a proof of income, for credit report history, right? Whereas in this case, all you need to make sure is to have enough cash value to borrow against. Okay. And then when you access the loan, you are in control of making those loan repayments as well. Okay. The insurance company will never come knocking on your door asking for loan repayments. You are free. You have the control of setting the terms on the loan repayment schedule. And that's something that as you work with us, our wonderful coaches will help you with. Question for everyone. Okay? And if you don't know the answer, that's fine, but I want you all to guess. So when you receive a policy loan, whose money do you think you're getting? Ah,
I'm
okay.
showing the insurance,
Mhm.
our own money, mine, insurance, mine,
Okay.
insurance companies, different answers.
All right. So we're getting all kinds of answers, and I sort of expected that to happen. So a lot of you are saying mine, and a lot of you are saying it's the insurance company's money. So we essentially have a split crowd. So the answer is it's the insurance company's money. It's not your money that you're getting. So if you're getting the insurance company's money, then where's your money?
And I'm getting answers growing, and the policy, growing,
I saw someone that has
compounding.
said, "Oh, it's growing," and I love that
Yes,
because
yeah,
that's a very typical response or reaction that we get when we ask that question to our clients. Right? It's almost like a light bulb moment that goes off. So
yes.
yes, your money is growing in the form of the cash value inside the policy, and guess what? It's uninterrupted. The growth is occurring uninterrupted. So you haven't actually touched your money. You've converted it into cash value that you now know is growing every single day because it has to match the death benefit by age 100. And so as that's happening, you are accessing the insurance company's money to carry on with whatever you need money for. Now, another question, logical question. Is the insurance company going to charge you an interest on the policy loan you take out?
Okay, I'm getting no, yes, yup, no, yes, yes, yes. Lots of yeses.
Yeah, yes is the right answer. If you think about it logically, there's no free lunch in this world, right? If you need access to capital, no one's going to lend you access to money for free. Right? And if you are one of those people, just give me a message, hit me up after the meeting, okay? But most of the time when you want access to capital, there is going to be a fee associated with that, okay? And so in this case, the insurance company will charge you an interest. Now, sure, they're charging you an interest, okay? And we're not going to focus on the rate here, but we're going to think about it from a reason and logical standpoint, okay? So what else is happening in the policy while you access a policy loan?
Let's see, growth. I'm reading interest, growth, saving, compounding. Somebody put down, Cynthia. Alan put money is growing. And then cash value continues to grow.
Yes. Your cash value is continuing to grow uninterrupted. So always remember, while you access that policy loan, your cash value is continuing to grow uninterrupted. So the question becomes, if the daily interest that is owed on the loan that you take out is lower than the daily growth of your cash value, will you be behind or ahead financially?
Okay, that's a tricky one. Let's see what's coming up.
Yep.
Ahead. Well, it's a strike home. Ahead. That's all I'm getting.
And that is the answer right there. Okay? You will be ahead because it's not about the rates, it's about the volume. If the volume of interest charge is lower than the volume of the cash value that's growing every single day, you will always be ahead financially. Okay. And the way we design these policies at Ascendant Financial, it's designed in a way to make sure that you will be ahead financially. Because that's what we want to do. Because that's how we get to the objectives, to the whys that you all shared that you want to achieve in your lives. Now, for every dollar that you repay on your policy loan, will you be able to access the same dollar again or more?
I'm getting more. Neil is putting more. Alan, more. Joanne, more. Cecile, more. Seem to be just more and more.
Yes, more is correct. Remember the image. Remember the diagram I showed, right? Again, sear this in your brain. And you can take a screenshot of it. There's no problem. There's no copyright issues here with this particular image, right? If you can sear this in your brain, you will never forget how the IBC concept works. Okay, because your cash value will continue growing every single day. And when you make those loan repayments, because the cash value continues growing, you'll get access to not only everything that you repaid, but whatever growth that occurred over that time frame as well. And who's in control of making the repayments? Everyone.
Okay, let's check. Oh, me. I am. Us. You. You are. I am.
And so how much value would you put on control? What is a price that you would put on control?
Priceless. That's coming from Cynthia. Neil, priceless. Yeah, that's what we're getting.
Amazing. So what you just witnessed is an alternative way to flow your money that helps you keep more of it over time. Okay. The infinite banking concept has nothing to do with investing or rates of return. It simply gives you more control over the way money flows in your life. If you owned an asset where your capital grows uninterrupted on a tax-free basis, yes, you read that right. And it gives you access to capital tax-free on your terms. And it provides tax-free capital at debt to your loved ones. How much of your money would you not want residing there?
And I'm getting none. Beautiful. Zero, none.
You got it. So make sure you schedule that meeting with the coaches. All right. Because we can show you how we can implement this in your life with your scenarios, with your objectives in mind. Okay. And that meeting, you don't have to bring any money to it. You just have to bring yourself, your questions, and keep an open mind. And our wonderful coaches will guide you through how this process can help you. Take it away, John.
Thank you so much, Taran. That was beautifully done. So let me share my screen. Let me know if you can see my screen.
Yeah, we got it.
Awesome. So just go here. We will leave you with this. Tonight, you have heard a lot of information. And to make sense of it all, you can reach out to one of our advisor coaches who will take the time to bring clarity and answer any questions you might have. And this clarification and the time they will take, it's completely free. So please put down on the chat box for me the number where our panelists and our attendants can reach out to one of our advisors, please. Thank you. So we want to leave you with by adding one extra step to what you are already doing financially, which is the process of becoming your own banker. You can imagine having total control over your financial future, reduce your financial risk, enhance any financial outcome, and never lose control over access to money. Please put down how would you feel should that be happening to you if you had complete, utterly control over your finances and your money. It doesn't matter how much premium you start with, but the beauty of it, you must start. You know the old adage that goes as, when is the best time to plant a tree? And most people will say, depend on the tree. For an apple, it might be 5 years, 10 years ago. For an oak tree, maybe over 100 years ago. But what is the next best time to plant a tree? It is right now, so that you start the growth, you start the compounding effect regarding the infinite banking system. And when you do, like me, like so many of us who have been practicing and seeing for ourselves the result, the peace of mind, you will feel amazing about it. Don't just hear it from us. We have over 1,000 5-star Google review of raving clients who love doing business with us. And we can take the time to read. Just gonna check the time here. Okay, we're doing good. We can read one here. This past year, I have been working with Elizabeth Wall and her team. I am extremely pleased on her professional and the quality of work at Ascendant Financial. Elizabeth and her team has been nothing but patient, transparent, and a guide throughout the process of getting my application started, and I am pleased to say I have been approved for my first policy. And we have so many other advisors like Isabel who are patient, who understand the system and can help you implement this system the right way. I can read one more from Jinjin. So that review says, Jinjin is forthcoming, honest, and seems to care about her clients. She is easy to work with. So there you have it. You can go on Google review and read for yourself those beautiful testimonies. The one thing that all those people have in common as clients of financial Ascendant Financial is they took massive action. So intention is good, action is better. So I will call on you to take action tonight. Book an appointment with one of our advisors. In Canada, you can text schedule to 780-809-4599. And if you are south of the border in the United States, you can text schedule at 828-13793-7921. And on that, we will take some questions and answers.
All right. So what we'll just ask people to do, if you have questions, please put them in the Q&A box. So everybody, if you look at the bottom of your screen, you'll see a Q&A box. And just put your questions into there and we'll do our best to get them answered for you. So I've seen a few questions pop up throughout the night in the chat box. So those of you that had those questions, feel free to put them in the Q&A and we'll do our best to answer them for you. Does this work for people in their 50s? That's a great question. I'm going to answer that one. I started when I was 55. So the answer is yes. Another great question. Tran, you want to answer this one? Can you lose money with the infinite banking concept?
A great question. So just like any tool in life that you use for a process, it all comes down to how you use it. And so the only person that can break the tool is the person using it. And so if you don't use the tool correctly, then yes, you could be in a position where you could lose money on it, right? But if you use it correctly and you use it the way we coach you to do it and the way Nelson Nash teaches us to do it, then there shouldn't be any reason for you to lose any money utilizing the system. Dan?
100%. So yeah, if it's used the way it's intended to be used and the way you're coached to use it, you shouldn't lose money. And it's really, it's the lowest risk thing I've found to do with my money. So another great question, how can we track our daily growth versus interest? So that is a great question. So you can go and look at your cash value growth day over day. So depending on which life company you're with, the one we like to use, you can go as an individual and look at your cash value growth one day and look at it again the next day and you'll know how much it's grown. And as far as the cost of interest, it's a published number. So if you borrow 10,000 and you know that's a simple interest, it's going to be calculated daily. Well, you can just apply the interest rate and then, divide it by 365 days and you'll get the cost of interest per day. So that's another great question for your coach. That's the kind of information. And John talked about it early, like our portal, client portal for all of our clients, you can go in there at any time, 24/7, and get access to these kind of questions and just go, okay, how does that work again? Well, you can go and see. So that's one of the things we provide for our clients. So great question. Hope that answers it for you, Sharon. Neil has a great question. And Paul, you can answer it. If you want to insure someone, do you need their permission?
The short answer is yes. We need someone's permission before we can insure them.
Yeah, unless they're a minor and you happen to be there, they happen to be your child or someone, and you have. That's the only time that wouldn't be the case.
Yeah, the next question is pretty good too, Dan. How much dollars is needed for a policy? And that's an incredible question for your coach. So if you don't have a coach, text those numbers that came in, and you'll get plugged in with one of our incredible coaches. But the cool thing about this process is everybody's unique and everybody's system's unique. And so we really build them around a person or your family's goals and objectives. So there's no set answer for how much dollars you need. But yeah, talk with a coach, and we want to know what your goals and objectives are, and then we'll help build it based around that.
All right, great answer.
To add
But
to what Paul said, the most important thing when it comes to this process, it doesn't matter how much money you start with, but it does matter that you start, because the compounding has to start somewhere. So if you can start with $100 per month, you start with $100 per month. If you can start at a higher amount, you start at a higher amount, right? Each individual circumstances are different. Each individual's objectives are different. And that's something that your coach will help you through to understand what is the right place for you to start at.
Here's a
excellent.
question. A
So,
question here, Dan. How frequent can I take a loan out from my policy? I will throw this one to you, Dan, if you can help us.
well, again, it's just what Tran had spoken about. So it all depends on the behavior of the policy owner. So, you know, in most circumstances, and not all cases, but you can take a policy loan shortly after you start your policy. But there is, minimums that the life insurance company will lend. So you have to get enough cash value to get above that minimum, and it's pretty low. So for some people, it's right away. For other people, if they start at $100 a month, it's going to take a little longer before they can take a policy loan.
Thank you.
All right, does this work for people on a fixed budget? Yes. So as long as you have the capacity to put some money away, it can work for you. If all of your needs are using up all of the income you have coming in, you may need to do some consideration of your spending, because you have to be able to pay premiums. How frequently can I take a loan out of my policy? Tran, you want to jump on that one?
I thought we answered that one already.
That's the one you did, Dan.
Okay.
Yes, I did skip one.
So you can take it out as often as you have access to money and have a need for money. And I thought there's the next one. How long do you need to have a policy to use a loan? We kind of answered that one. And how does the company make money? So that's a great question. How does the life company make money? Now, Tran spoke about one way that the life company makes money. There's more than one way. But when I or you take out a policy loan and they charge interest, that's one way that the life company makes money. So they're making interest on the money they lent you. Now, there's multiple ways that they make money. They will invest it in things like bonds. And not only do they put it in bonds, they keep those bonds through to maturity. So anybody can go look at a life company's website and find out how they have their money invested. There's multiple ways they put their money to work, but they have to. And they've been doing it for over hundreds of years, and they're very good at what they do. So yes, they put the money to work, and that's how they grow their money. Multiple ways. They lend money to, blocks of money to entities that use it for different things. Real estate's another way. I don't want to get too far into it, but it's a great question.
The next one is quite nice also. What does Ascendant Financial charge for their coaching service? You want to take this one, Paul?
Yeah, sure. That's a question I love to answer is we don't charge our clients any hourly fee or anything like that. Is we get paid directly by the life insurance company. And so because of that, we get the joy of working with our clients and not having to charge any fees. The only time we may charge a fee is if we do live events, or something like that, because there's those costs that we have to cover. But coaching and all those meetings with clients we get to do for no charge.
What we do ask is, though, if you find value in working with us and it's helping your situation, is to spread the word. That is something we definitely ask for in return for all the great coaching that we do. Right? So sharing it with your family and your friends and your loved ones that can also benefit from this wonderful process.
Yeah, there's a few more questions about cost and how much to put in a policy, and again, that's it's a great conversation to have with your coach, and and for them to actually take a look at your situation and what your goals are. So
Exactly, and it'll be up to you. That's what we
mhm.
let people make the decision how much they want to start their system with and put into their system. How long do I have to repay my loan before I start getting charged interest from the insurance company? So great question, Cecile. So as soon as you take a loan, there's going to be simple interest. It's calculated daily. So you will start to incur an interest cost, as soon as you take that loan. Just like Tran went through in the presentation, when the policy is designed properly, the cash value growth is going to be greater than the cost of interest. Now, really what this is all about is changing the environment that you do anything financially in. And when you are able to borrow money, where your money grows at a greater rate, you've changed the environment that you have access money through.
Oh, there is one question that's a little bit long, but let's give it a try. How is it better to put money into IBC and borrowing the funds for down payment versus putting the money down? So one way I could take a jab at this first section of this question is, when you pay for things, what happened to your money when you pay for that thing? The money is gone, and it is gone forever. As to when you put it into IBC, it's growing for you on a daily basis, compounding, and you have access to capital.
Yeah, so if you put your money into the policy, 100%, it's going to grow uninterrupted. And if you just pay your down payment, just like John said, that money will not grow for you the rest of your life. Okay, so Malcolm's got a great question. Can a policy loan decrease a dividend payment or any other cash value appreciative factor? So a policy loan does not impact your dividend unless, there may be some life companies in the US where you could have an impact, but the companies that we use, you will not see an impact to your dividend payment by using policy loans. So the policy does not impact the cash value growth, or the policy loan does not impact the cash value growth, and it will not impact the size of your dividend.
There is a great question for you here, Taran. Do policies depend on health concerns?
Yeah. So at the end of the day, the life insurance company is in the business of assessing risk and protecting themselves as well and protecting the pool of capital that they manage. So they definitely take into consideration the health of individuals. And so your health is definitely something that uh, should be in good standing because it will benefit you when it comes down to applying for a policy. But that's something that you shouldn't focus on at the beginning. What you need to focus on at the beginning is understanding how IBC works and how it can work in your situation. And then your coach, as you work with them, if you are experiencing some health issues and you share that with your coach will be able to guide you as to what is the best path forward in terms of a policy design and what the chances are of you getting approved on your policy as well.
All right, so here's what I'd like to do to get everybody to jump into the chat again. Just wanted to ask you, what was your biggest takeaway from the webinar we presented tonight? So if you were going to put that in the chat, what would you say? Yes, there's not a lot. Nope. So what would you say was your biggest takeaway from tonight? Just to repeat the question.
Yeah, there's some money compounds while you borrow. One person, all about control. Take loans from yourself. I've received knowledge and I'm excited about my future. just a great reminder and reinforcement of ideas.
Excellent.
Someone wrote, feel more ready now to move forward. So lots of really good answers coming in here.
Yeah. I guess the next question I'd ask is, so what would be the downside to, just booking a call and talking to somebody about how this may look for you on an individual basis? Because that's where you're going to get your clarity. So what would be the downside to just booking a call and having a conversation?
And we're getting a lot of no downside. None. No.
Excellent. So yeah, just some questions I wanted you to think about. We got another question here what would be the current average interest rate for policy loans from Luke? So that's a great question, Luke. And it kind of depends which life company you have it with. So they vary. They will, some will follow the, Bank of Canada rate, other ones won't. So that's another great question to ask your coach. And when the coach starts talking about a certain company, he can tell you what the interest rate would be. And yeah, one of those things we talk about for sure. But it'll vary from 4.5% to 8% probably right now, depending on which life company you're with. All
And
right.
maybe we can ask them the last question, Dan, is on a scale from 1 to 10, can they grade us in terms of value? 10 being great, wonderful value. Can you put in the chat, please? Awesome. Thank you. Lots of tens. Awesome.
And as the tens are coming in, who has already booked a call? Who are those action takers with us tonight? They've
Oh,
already
Chris. Thank you, Chris.
nice. Got a couple me's done.
Ooh, John, thank
Awesome,
you.
Nathan, Chris, John,
Mhm.
Eustace.
Luke's already got
Luke,
3
that's
policies.
amazing.
Woohoo. I think one of the things Nelson used to always say is, he said, nobody's ever got hurt by, answering a question or having a meeting. So please book those meetings and you'll get some clarity around all your great questions. All right. Any more questions? We're gonna give 3 more minutes for questions, and then we're gonna give everybody the rest of their evening back.
Okay, one question that we have here that can be relevant. What happens if you have a policy and you lose your job and you can no longer pay the policy premiums while looking for a new job?
Great question, John. So again, it's gonna be dependent on how long you've had the policy and how you've been funding it. So that's a really good question. We give lots of flexibility. That's what you'll find, is there lots of flexibility between what you can pay and what you have to pay. So we'll set you up for success. We always have conversations with people. We want to make sure the minimum required premiums they're very comfortable with. So that's kind of the way we structure them.
Thank you.
Yeah, and I recently worked with a client who was in that situation where he did have a loss of income. And so we looked at a solution at how to still hold on to the policy so that he could continue contributing his premiums. And so there are a lot of options, and the options that he ended up going with was reducing the amount that he was putting into the policy so that he could continue keeping that compounding. Remember, it's all about not interrupting the compounding. And so those are some of the options available to you when you're in a situation like that, among other options.
Yeah. Good point, Tran, because that's definitely an option. And over time, we've worked with people to do that. And there may be a rider that you can reduce. They're just different options. So it's a great question to ask. And Chris asked, can I get a policy for my kids? Sure, that'd be a good place. I appreciate when families have policies on everyone because you never know. And it's the best time to start a policy is when you don't need it. And so children, I have all my grandchildren insured and children. So I would definitely say children, you can get a policy for your kids, Chris.
That being said, we are 1 minute to 10 Eastern time.
Somebody wants to know what insurance company we work with. There's a multitude of them. So we work with a lot of different life companies. All right. So thanks to everybody for coming out, spending this last hour and a half with us. I hope you, take action and follow up, because without that, if I hadn't, taken action when I heard about it, I wouldn't be in the position I am today. And I'm just going to encourage you to do the same. Until next time, God bless you all.
God bless.
You can tell really fast if someone wants to commit to doing IBC the way it was designed to be done, which is really stage 3, stage 4, or whether they just want a safe place to store money. But the biggest issue is when you commit to a lower stage, but think you should be able to do all the fun things that people are doing on stage 3 and stage 4 and have it make sense. You have to add intention. Money has to be put in on purpose in advance